I would just say recession or no recession, I think that a lot of the growth in GDP is an illusion. The economy, you could argue, and you could argue forcefully, that it's not in a technical recession, but I think it's far less strong than what the GDP numbers are actually telling you.
Dave Rosenberg, founder and president of Rosenberg Research. It is such an honor to welcome you back to the show. Our viewers love having you on, and I am thrilled to have you back on today. Thank you so much for taking the time to join me, Dave.
Well, thanks for the invite. I just hope that it's not a case of misery-loving company.
That is so not true. I love it. And, sometimes you are that lone voice out there, but historically, you have been that lone voice who has been right. And I think the last time you and I spoke, it probably was 6 months ago, you had not thrown in the towel on the recession call. And I guess a lot has changed. I feel like so many people have thrown in that towel. So let's start, Dave, more with that big picture, where we are today, that macro view for you, the framework that you are using to look at the economic picture. And as you know, Dave, you can take all the time you need to set the table. Okay.
Well, look, there's absolutely no denying the fact that the BLS data, which produces the GDP statistics, are revealing a U.S. economy that's expanding at a 3% annual rate. That is an uncontrovertible fact that can't be disputed. And I think that it's that growing impatient by those who were in the recession camp that threw in the towel that these GDP numbers, they just stay at 3%. They never seem to deviate from that. I can only say that in my 40 years in the business, I don't recall seeing such massive divergences amongst all the economic indicators. So, for example, the Fed has been stating that they are focusing attention on survey data. And when we run this model that's premised on all the various surveys, the ISMs and consumer confidence polls, and we formulate it into a model, it's spitting out growth in the economy of closer to 1.5%. Would you say, okay, that's still not negative, which is true, but it's what I would characterize as a growth recession as opposed to an outright contraction in economic activity. Of course, what makes the survey data different than GDP is that it's a survey of private sector participants in the economy, households and businesses. It doesn't include government. And I'll get there in a second. Mm-hmm. The Fed's Beige book, which is the most powerful, albeit anecdotal, piece of information that comes out every 6 weeks, it first got released in 1970. It was called the Teal Book, and then it was called the Tan Book, and now it's the Beige Book. So it's changed its colors over the course of the past 5 decades. But it is extraordinarily rich in information on how the economy is doing across sectors and across regions. And what's very interesting to me is that heading into September, even in the context of the BLS reporting 3% real GDP growth, the Beige Book, meanwhile, was telling us that 3/4 of the country were either in stagnation or contraction mode. And we run this AI model on the tone and the commentary out of the Fed Beige Book. And it was just as weak as it was heading into the 2008 recession, the 2001 recession, and the 1990-91 recession. But apparently there's no recession. So that's what I mean about this dichotomy between the color and commentary you're getting out of the venerable Fed Beige Book and the incoming survey data, which is soft data, not hard data, but it is telling you something completely opposite than what the GDP statistics are revealing. And, people are talking about the fact that, for example, that the Citigroup Economic Surprise Index has been improving recently. And that's not really a sign of economic strength as much as how is the economy performing against expectations, and maybe the expectations of late have just been far too downbeat. But I'm looking at, the trend, not the monthly noise, but say the year-over-year trend in the wide gamut of high-frequency data that we get every month. And look at the year-over-year trend, for example, in auto sales and retail sales volumes and home sales and industrial production and real inflation-adjusted core CapEx orders and shipments. And they're all running flat to negative on a year-over-year basis, but somehow we have real GDP at 3%. And of course, that's what everybody bows down to, is the holy grail of GDP. But what does GDP contain that surveys don't contain, and what the statistics that I mentioned don't contain, and what the Beige book doesn't contain? Because I mentioned before, the Beige book is a survey of households and businesses across the U.S. economy. It doesn't include government. And so I think that what has kept the ball rolling and what is contained in GDP is the influence of government. And I have to admit, I will throw my hands up in the air and I will say, this is what I got wrong. I did not assume, and of course, in this business of forecasting, your conclusions hinge on your assumptions. My assumption was that there was going to be maybe some semblance of sanity returning to Washington, but no. That for the second year in a row, the deficit to GDP ratio is exceeding 6%. You go back to 1960, and the federal government typically fought recessions by taking the deficit GDP ratio to 3%, rarely above 4%. And here we are in each of the past 2 years, well past the COVID disaster, well past the reopening trade, well past all the Fed and stimulus checks. 2 years in a row of deficit to GDP of over 6%. That's a $1.8 trillion deficit. So people talk about, this concept of American exceptionalism, which, to be honest, I buy into in terms of, where the biggest technology inflection points, or even in healthcare, has happened in the United States. I would still say the best companies in the United States are situated in the S&P 500, not necessarily the best stocks, but the best companies. But then people look at 3% GDP growth and contrast that with the rest of the world, saying, well, look what's happening in the US. But the rest of the OECD is running a deficit GDP ratio of 3%, less than half of what it is in the United States. So I don't know, maybe we have to introduce a new ticker in the New York Stock Exchange called GOV, government, because I wasn't anticipating that government spending would be up 10% this year. I was not anticipating we're going to have another year of 6% plus deficit GDP ratio, which is, with all the multiplier impacts, really been the underpinning for this 3% growth in overall real economic activity. So I think that's really where we are. And look, we have both candidates for the November 5th election. They're both campaigning on basically putting root beer in the water fountains, and everybody just laps it up. So if it isn't child care tax credits and low and middle income household tax credits and business subsidies and giving people, first-time buyers, a down payment to buy a home, this would make FDR blush back in the 1930s New Deal. And of course, you got under Trump wants to, invoke interest relief tax deductions for auto loans. So the fiscal spigots just keep on going along. And I think that's really what's given this allure of strength in the overall GDP numbers, by the way, which is devoid of what you're seeing in survey data, the Beige book, and actually a lot of the other incoming high-frequency indicators. But the focus is on GDP, and everybody's got the previous recessionistas have thrown in the towel because they focus on GDP. I would just say recession or no recession. I think that a lot of the growth in GDP is an illusion. The economy, you could argue, and you could argue forcefully, that it's not in a technical recession, but I think it's far less strong than what the GDP numbers are actually telling you.
Yeah. It's interesting you bring this up because this has come up on the last two episodes. I had Professor Steve Hankey. That episode is airing today, Tuesday, October 15th. And then last Thursday, I had Eric Basmajian of EPB Research. Both have talked about this in government spending. One of the things I learned in my conversation with Eric Basmajian is that government spending it's about 35% of GDP. And then Professor Hankey said really the spot where it should be is closer to like 10 or 11. I don't want to botch what he said, but I think he said it should be around 11%. But it is concerning the direction. I personally did not know how big of a percentage it is. It also makes me wonder too, what about the growth in government jobs? Just maybe more of the growth in government. What kind of trajectory does that put us on?
Well, I wasn't talking about sheer GDP. I was talking about just the year-over-year percent growth. But it's 100% true that the share of the economy accounted for by government spending, and it's not just federal government spending, but you've also had the state and local governments that had really were flush with these rainy day funds from all the transfers they got from the federal government during COVID that have continued to get spent on infrastructure and so on and so forth. Government employment has been a major source of strength in the employment data. And what was really striking as we wax on about the September employment data was that 785,000 government jobs were created in the month of September, which is insane. Only one other month, and this is seasonally adjusted data.
Wait, repeat that number one more time for the folks.
785,000 government workers in September. Maybe they're all working for the campaigns. You tell me. People will say, well, of course, you got teachers returning from summer and going back to school. No. These are seasonally adjusted data. 785,000 has only happened one other time in the past. It was in June of 2020 when everybody was returning back to work because we had the economic reopening of the economy and people were coming back to work. So that was just a bounce off of a depression impact in the previous months. So we've only going back to, 1948, second biggest bulge in government payrolls on record. So again, it's the, Ronald Reagan told us in his inauguration speech in January 1981 that government is not the solution to our problems. It is our problem. But now it seems as though we've just turned that on our head, but people just want more. There is not a policy platform to give candy to the voting proletariat that isn't just lapped up by the public. Just, give me more candy. So that's basically the environment that we're in. And that's really, I think, the American exceptionalism. 2 words or less. Fiscal policy.
This episode is brought to you by Public.com. Public.com has just announced its new bond account, offering a 6.6% yield on your investment until 2028 when the first bond matures. Here's why it's interesting. Bond yields have been at their highest levels since 2009. However, the Fed just announced its first rate cut and more are on the table. In fact, current estimates from the CME FedWatch suggest rates may fall as low as 3% by the end of 2025. The good news, investing in a diverse portfolio of corporate and high-yield bonds could lock in today's historically high yields, even if the Fed cuts rates. That's why Public.com created the bond account. It's a new way to invest in bonds and earn a 6.6% yield on your investment for the next 4 to 5 years. Go to public.com/Julia to learn how to lock in a historically high yield on your portfolio. The bond account, only at public.com/Julia. One of the things I've learned from hosting the show, from having folks like yourself, I also had Dr. Lacey Hunt on this program twice. And one of the things I learned from Dr. Hunt is that fiscal policy is contractionary. And I think that's also something that's important for folks to understand as well.
Over time, that's true. And you get the negative multiplier and you get the crowding out effect. That much is true. Over time, you reach a point where, when you're talking about the debt to GDP ratio heading towards 130%, you end up getting contractionary effects on the economy from the government largesse. In real time, though, because of course we're just focused on the here and now, it gives you a sugar high. And then the sugar high fades. And the one thing we know about government spending is that it's inherently unproductive and it crowds out private investment. And that's the one thing I'm scratching my head on, is that despite all the AI hype, there's been no capital spending cycle in the U.S. economy. There's really not been a capital spending cycle. It boggles the mind. The housing market is in varying levels of disarray. We know what's happening with commercial real estate. Where are exports going to go with Germany heading back in a recession and dragging the rest of Europe along with it? I mean, the EU is a bigger economic unit in aggregate than the United States is. And then, of course, if China wasn't in a deep economic morass and a structural slowdown, that Beijing wouldn't have been unveiling these flurry of measures in the past couple of weeks. But again, those are measures more addressing liquidity than really the fundamental factors that are undermining its growth potential. So the world economy is cooling off. You're not going to get an export reaction positively in the U.S. economy, and exports might be a tiny share of the U.S. economy. It's a large closed economy, but very powerful multiplier impacts on the manufacturing sector coming out of exports. I'm just tallying it all up. Of course, the consumer has hung in, and the consumer has continued to feed off, those stimulus checks, which are now in the rearview mirror, and the savings rate is still coming down. People are still accessing other forms of credit, whether it's in the shadow lending market like private debt or credit cards, although that has started to come under some downward pressure with delinquency rates at 13-year highs. But I am noticing, if you looked at the U.S. economy on a diffusion basis, of course, we always say, well, the consumer is 70% of GDP. So as the consumer goes, the U.S. economy will go. Of course, we have this other factor that's being an ongoing source of stimulation, which is government. But on a diffusion basis, the U.S. economy is actually deteriorating at a fairly rapid rate. I'm not talking about the average, or I'm not talking about the aggregate $28 trillion sum, again, which is dominated by the consumer. I'm just talking about if you took a look at the U.S. economy on a diffusion basis, you're seeing more decay than meets the eye. Manufacturing is flat as a pancake. No CapEx cycle. The housing market can't get out of its own way. And part of that is because existing homeowners have become prolonged prisoners in their own units. Having locked in at those generational low rates a couple of years ago, they can't move. So the housing market is completely sclerotic. I'm a lot of people will call that data mining. I prefer to call it data analysis. But I just come back to the overall premise that there is less verve, panache, impetus in the economy that meets the eye at the surface level.
Mm-hmm. And going back to the top of the conversation, is that more of the growth recession? Is that how you characterize it, that we're in a growth recession? Most
people would not agree because they're focused exclusively with tunnel vision on real GDP. Mm-hmm. But I would say that, as I said before, there's a lot of non-corroborating evidence that the economy is growing at half that pace. And yes, I would say that in the old days, when I started in the business in the mid-'80s, and we talked about 1.5% growth, not in GDP, but looking at the totality of the data, 1.5%, we called that a growth recession. And in fact, when we got to 1.5% in the past, I would get peppered with questions as to, so when's the real recession going to start? But of course, nobody's asking those questions. Every asset class is basically priced 0% for a recession. And I don't
Mhm.
believe in 0, and I don't believe in 100, but we have to play the probabilities. But I would say that you can build the argument that, the government will just continue to save the day. But remember that November the 5th is going to be very important because these two candidates are running on a lot of fiscal goodies. This is going to be like Halloween on steroids. But the treats will turn to a trick if there's not one party power, because all this stimulus is not going to make its way through the system if we have split government, which I think should be a base case scenario.
Okay.
If it
Elaborate a bit more.
isn't, then the fiscal spigots will just be wide open and will stay wide open until there's some sort of financial accident, like most likely in the bond market or the currency. There is no country in the world running a profligate fiscal policy like the United States is. You would think that the unemployment rate was at 8%, looking at the fiscal largesse, not 4%. It really boggles the mind. But if we get split government, a lot of the fiscal measures are not going to go through. And then a lot of the Trump tax cuts, not the corporate income tax rate, but a lot of the other measures that he brought in 2017, they sunset by the end of next year. And that's going to represent fiscal drag on the economy, fiscal drag that we're probably going to need to restore sanity and stability to the budgetary scene. But it will have an impact on those GDP numbers.
Okay. I'd love to just explore it a little bit more because let's say, okay, so those treats are going to turn into some real tricks if there's not one party in power. So it sounds to me like regardless of the outcome, we could be headed for maybe a recession. But I also wonder, could that recession be maybe, this could be a terrible question, maybe a good thing to wash out some of the craziness? Or if there is a one-party sweep, are we going to set ourselves up for even bigger problems because, we're going to be stuffing our faces with all of that candy. We're probably going to feel pretty sick.
Well, I think that, the problems will be once we get the problems, and I'm using, say, Canada in the early 1990s is a pretty effective template as to what to look for when a fiscal crisis is coming down the pike. And I think that you look at what's happening with your currency and what's happening with your government bond market. And in Canada, the currency went into a tailspin and the Canadian bond market became so unmoored and unhinged that Canada almost had, this is a G7 advanced country, almost had a failed auction back in 1994. That ultimately forced Canada into a decade-long period of fiscal austerity, which 100% was necessary. It cost the economy a lot of aggregate demand growth, but restored the country onto a path of fiscal probity and integrity. The United States, being the reserve currency of the world and still the world's largest army and navy, has a longer lifespan in this regard than Canada does, but that's what we'll know. We'll know that we'll know when if the U.S. dollar goes into a destabilizing decline, and we start seeing the Treasury auctions tail on a sustained basis, and that'll be the early signposts. But all that said, I think that the odds-on bet is that we're going to have split government, which means that the fiscal spigots will not be turned on as much. And it has to be recognized that it's not just the fiscal support, ongoing fiscal support and government influence on these GDP numbers, both directly and indirectly. But something else that happened along the way that prevented the recession from taking hold. But my motto is, delayed is not the same as derailed. And it's because, as I said before, everybody locked in at those interest rate lows in 2020 and 2021. So what that means is whether you're a corporate or you're a consumer, you did get a get-out-of-jail-free card for a period of time because the Fed raised rates 500 basis points, and people are astounded that it didn't even have a barely perceptible impact on the economy. But that's because debt service charges were held at bay because everybody had locked in. But you're not locked in forever. And right now, the Fed is sounding a little less dovish than they were before. And at issue here is we have a funds rate of 5%, but the average of the past 5 years is closer to 2%. That's a 300 basis point gap between the current Fed funds rate and where the normalized level was over the course of the past 5 years, before COVID, during COVID, post-COVID. And if you look at the wide gamut of interest rates that households and businesses are paying, that is basically where those interest rates are, is about, again, a 200, 300 basis point gap. In other words, if interest rates don't come down at the time of renewal, rolling over that debt, there's going to be a huge crunch to debt service costs that we haven't seen yet. The operative word being yet. That still stares us in the face, but it also tells me that to avert that calamity, the Fed is still going to have to cut rates substantially. But right now, because what they focus on, GDP, non-farm payrolls, they're going to drag their heels. But there's no denying where these households and businesses took on this debt, and the interest rate they're carrying is 200 to 300 basis points below the current spot rate, no matter what you're looking at, corporate or household. So that is still a big question mark over the economic outlook that's still out there, because there will be the pain. You see the pain that Jay Powell talked about when he first started raising rates in March 2022. All of a sudden, no pain. Well, then the analysis shows how many people actually locked in, but they're not locked in forever. So there's going to be there's going to be a payback at some point, and it could be as early as next year. So as I said before, I feel much like I did, back in 1989. Where's the recession? Where's the recession? The Fed started hiking rates in the winter of 1988. Where's the recession? Well, started July of 1990. Back in 2000, where's this recession? Where's this recession? Well, started March of 01. 2007, where's the recession? Where's the recession? The Fed actually started raising rates in that cycle in the summer of 2004. 05, no recession. 06, no recession. We get into 07, and everybody once again threw in the towel. Then, lo and behold, we had a spectacular recession starting in December of 07. So sometimes the lags just take a long time. And there's been periods in the past where those lags between when the Fed first starts raising rates to the eventual NBER-defined recession is 30 to 40 months. Mm-hmm. And we're heading into that zone right now. And what caused the lags to be longer this time around was, we said, government, fiscal policy, the spending, the excess savings being spent from the stimulus checks. That was a Energizer Bunny gift that kept on giving. And of course, the fact people had locked in. So that clogged up the policy lags. But they're still there. I'm amazed the Fed has stopped talking about it, but those lags are still there. Mm-hmm. And it just reminds me most of 2007, because back then the lags took so much longer, because till the bitter end, even with the run-up in interest rates, remember the Fed took the funds rate from 04 to 06 from 1% to 5.25%. It was almost as pernicious a tightening cycle as this one, and right till the bitter end, what was the offset? Was the ongoing ability and willingness of the household sector to extract equity out of their homes, right till the very end. Cash out refinancings, yes. Mortgage equity withdrawal, what we used to call MU. And what's interesting is that the consensus did not start to call for recession until the summer of 2008, in between the time period that Fannie and Freddie went into conservatorship and the time that Lehman collapsed. And then people were surprised in December of 2008 that the NBER had the temerity to date the recession to December of 2007. Why? Why? Because of all the downward revisions to the data. And we haven't seen all the downward revisions to the data. We just know, looking at non-farm payrolls, which again is the holy grail for all the employment indicators people look at, they've been revised down in the past year 75% of the time. So the NBER waits for all the revisions because what you see in time A is not always what you get in time Z. And then when you think about it, it was not the financial collapse that caused the recession. The financial collapse really began with Bear Stearns in March of 08 and then culminated with what happened in the summer of 08, September of 08, with Lehman, NAIG, and Merrill. The collapses didn't cause the recession. The recession caused those financial collapses. By virtue of the fact that what do recessions ultimately do? They dry up cash flows needed to service the debts. And I don't think that's going to play out. I don't think it's going to play out any differently this time. I am not a new era enthusiast. I don't believe in new era thinking. I do agree that every cycle has its own peculiar characteristics, but I do think that patterns reemerge time and again. And there's a reason why every recession in the post-World War II period was presaged by a Fed tightening cycle that not only raised interest rates, but inverted the yield curve. And then we have to assess in current time, what are the factors that are acting as antidotes to the damage the Fed has done? And so that's what we're talking about on this call. And that's what I was talking about in 07, where I said back then, and I'm telling your viewers today, delayed is not derailed. And so this is not a deliberate attempt to be stubborn. Why I'm not throwing in the towel is because even though it's taken a long time for the recession call to take hold, I still see those pressures coming down the pike, and it's very difficult to time. But the recession that I thought we were going to get this year probably has been delayed to next year. The recession that I thought was going to take place in 06 finally took place by the end of 07. And then by the end of 07 into 08, people forgot that Rosenberg was early on his call. By the summer of 2001, people forgot, Rosenberg was too early calling for this back in 2000. So I'm early to a fault, but that's because I spend most of my time trying to protect people from, the other side of the cycle, which always happens. To tell me that the business cycle has been repealed, you might as well tell me, that the earth is flat and the sun is not going to shine in the morning. The business cycle has not been repealed. This is still an inherently interest rate and credit-driven economy, and we just haven't seen the full lags play out yet. But I believe strongly that we will.
Well, you get my attention when you just say that. It reminds you of, most of 2007. It definitely get my attention, and I just appreciate you just taking the time to elaborate a bit more. One thing I do want to bring up with you, Dave, because it has come up on the show in recent weeks. You mentioned that huge downward revision of the non-farm payrolls of 812,000 was a downward revision. The most recent report we got, the headline was 254,000 new jobs for the month of September. And I brought this up with Professor Hankey, but when I see that, it kind of makes me, and maybe I'm a bit of a skeptic here, it kind of makes me not really trust the data that's coming out. Like, how do you think about the jobs data?
Well, we have to remember that one thing that COVID changed was the response rate to the initial data on everything. And remember that whether it's employment or whether it's retail sales, we're operating off of a first sample. And when it comes to, say, the non-farm payrolls, remember it's a payroll survey. It's a survey. And it's taking small businesses time to catch up, to send their numbers into the BLS. So there's lots of guesswork. It's interesting that in the ADP numbers, small business employment is down 2 of the past 3 months. And they're getting increasingly late in getting the data in, but then they eventually will get the data in. So there's a lot of guesswork, more guesswork than normal in those non-farm payroll numbers. And I tell everybody who's willing to listen, do not trade off these numbers, because you're probably, you think you're right. You're going to be right 3 months later, but on time X where it matters, you're going to be wrong. And the 10-year treasury note yield is going to be up 15 basis points. And then when you go to your clients 3 months later and say, look, I was right after all, look at the downward revisions, they're going to say, well, so what? What have you done for me lately? I would not. The response rate for the payroll survey is down to almost 40%. So that's what we're dealing with. The error term, the sampling error term, has rarely, if ever, been as high as it is today. So that's why we're getting a lot of these revisions, because with the revisions comes, the new information that the BLS didn't have at the time that they issued the initial report. Very wide error term around these numbers. And then the other thing we have to consider, if you believe in the veracity of the September payroll report, you have to ask yourself the question, how could we have hired net 254,000 people in that survey, and yet businesses cut the work week by 0.3%? So let me get this straight. I'm going to hire you and I'm going to cut everybody's hours. How does that work? How is that even rational? You see, what was interesting to me in that employment number, and why I wasn't cheerleading from the sidelines, was the most important metric coming out of the data is what's called the index of aggregate hours worked, which is not just bodies, but hours. Like if I hired you and I said, I'm going to hire you not to do anything this month, where's the economy going? Oh, I hired you. That's nice. And you're idle. Mm-hmm. In actuality, what happened was that the decline in hours worked was so significant that it offset the headline increase in the body count. So the index of aggregate hours worked actually declined 0.1% month over month. Actually, the index of aggregate hours worked, which is important because it is total labor input into the real economy, has been flat, completely flat over the 6 months to September. So knowing that, how do we get lulled into the consensus view? And the consensus is entitled to its view, but how do we get enticed into that view, knowing that total labor input, hours and bodies together, have flattened over the past 6 months? So everybody is focused on the bodies, but they're not focused on the fact that the work week, which has been cut to 34.2 hours, which by the way, is the same level that presaged each of the past 3 recessions. So as I dig deeper and I sort of scratch the surface with my fingernails and I see what's underneath, it's not ratifying what the consensus view is on the economy. And it's not ratifying this 3% growth we're seeing in real GDP. Not that I believe in conspiracy theories. I'm just saying that I'm not seeing validation in other sources. But I'll tell you something else, which is the symbiotic relationship between the equity market and the economy.
Yes.
Yeah. And of course, you look at the equity market and you say, well, the equity market's telling you that the economy is booming. And if you look at the equity market, you'd see, well, the surge in equity wealth for a certain strata of the population, people are seeing their 401ks grow like Jack and the Beanstalk. So if you're saying, well, my portfolio is expanding and I have a lot more confidence in my retirement savings, I can spend more of my current income. And that's also what's been happening for the economy, is the decline in the savings rate in support of consumer spending. And the question is, and it's a symbiotic relationship between the equity market and the economy. They both drive each other. But what has me a little concerned is that earnings growth is actually slowing. Now, the pundits on Bubble Vision will say, well, we're at an earnings-driven rally. and corporate earnings are still rising. Yes, indeed. Corporate earnings, third quarter, tracking 5 to 6% year-over-year growth. The S&P 500 is up 34%. It's like, call it 7x. So what's happened here is we've had a gigantic expansion in the market multiple. The forward PE multiple has gone up 4 points in 12 months from 18 to 22. So this is not an earnings-driven stock market any longer. If it was, the S&P 500 would be at 4,600, not 5,800 and change. That's just the math. Most of this market move has been the multiple expansion because of the exuberance and the excitement and the confidence that investors have over the landscape. So I would just submit to you that one of the principal risks to the bullish view on the economy is what happens if the movie, for whatever reason, it could just be simply mean reversion of the multiple. You know, the long run PE multiple is 16. We're at 22. You don't want to know where the market goes. If we ever did face the Bob Farrell classic rule number 1 of the market rules to remember, mean reversion of the multiple would be very painful unless we had an unremittent earnings boom. But we know that earnings are slowing, actually, and that fourth quarter earnings estimates by the consensus in 2025, earnings estimates by the consensus haven't budged in months and are actually starting to roll over. So I find it just very fascinating, and it's human nature that at the end of last year, the consensus for the S&P 500 for the end of this year was 4,850. Julie, we're 1,000 points above that. And of course, the consensus playing catch up and marking the market share projections is now at 5,600 on its way towards 6,000 because you have to play catch up. But does it make sense? Does it make sense? You see, a 22 multiple from an equity risk premium perspective makes perfect sense when bond yields are 1 to 2%. Which is where they were a few years ago. They don't make sense when bond yields are 4% plus. The equity risk premium is a razor-thin 45 basis points, whereas the long-run norm, going back to Bob Farrell's rule number 1, is closer to 300 basis points. So God forbid if the equity market ever realize the extent of its current excessive overvaluation, or to correct that overvaluation, for whatever reason, we would have a very big negative equity wealth effect on spending, and the savings rate that's only been coming down. Remember, it started before COVID, it was 10%. Now, even after the revisions, it's 5%. I'll tell you that is, I think, the principal risk is what a bear market in equities for whatever reason. And I'm very concerned about the valuations right now. You know, people say, well, valuations only matter when they matter. Yeah. By the time they matter, it's an elevator going down.
Yeah.
And
it's interesting. Yeah.
Well, I'll just say that, you know, there's a lot riding on this because nobody has rebalanced. Julie, nobody has rebalanced their portfolios in this bull market. You know, that in the past 5 years, the stock market has practically doubled. Mm-hmm. And it's up 34% in the past year. But because there's fear and there's greed and there's greed and there's fear, these primal emotions, nobody has rebalanced their portfolio. Nobody has taken profits. Diversification has become a dirty word in the financial sector vernacular. And so we have a situation where over 70% of the household sector asset mix in the United States is in equities. 70. Unprecedented. That
and
takes
even
out the
like when
highs,
all other market environments lead. Wow,
highest,
so this
high,
is
it
high.
takes out 1999 tech bubble.
Yeah.
So only 8%. Believe it or not. Well, of course, bonds are for losers, right? What's sexy about the bond market?
That's so not actually. You know what? I like the bond market, folks.
Well, look, Lacey and I are joined at the hip.
Yeah, and
But
I'm a
only,
huge fan of Jeffrey Gunlock as well, and would love to have him on the show. So
yeah, Jeffrey is
Bond King.
terrific, and
Yeah.
both in word and in deed.
Yes,
Because
he's one of my
he's got
all-time
a stellar
favorites.
track record.
Yeah.
No, but I'll just say that 70% for the aging but not aged boomers. I'm one of those. Aging, not yet aged. People over the age of 65, 60% of their asset mix is in equities. Julie, it should be between 30 and 40%. Nobody has rebalanced their portfolio. They are all in. They are all in. And everybody's got the new era secular bull market thinking, and that there are no such things as recessions anymore. The business cycle's been repealed. And I get really nervous. Maybe I've read Benjamin Graham's masterpiece, Security Analysis, and maybe I've read Charles Mackay's Extraordinary Popular Delusions and the Madness of Crowds. Maybe I've read those books far too many times. However, they keep me grounded, especially today when I go to the circus and the stock market's become a circus and I see the clown blowing up the balloon bigger and bigger and bigger every single day. But we know what happens to a balloon. This is a gigantic balloon. This is the biggest price bubble in the stock market since, only two other times historically, 1929 and 1999. And in 1929, Irving Fisher famously said that the stock market has achieved a new and permanently higher plateau. And that's really the mentality that you have on your hands today. Take a look at the just released, the Global Fund Manager Survey that just got released by Bank of America. The sentiment is incredible. But I'm not just looking at sentiment. I'm looking at positioning. And I'm looking at the fact that we have tremendous concentration of risk on household balance sheets. And especially in the part of the demography, people over the age of 65, has me really nervous as to what happens if the movie starts to run backwards. You're going to find a lot of those people over the age of 65 that have retired are going to be applying for jobs as a cashier at Walmart. There's going to be all sorts of social and economic dislocations. Because everybody can't see past the tip of their nose. They don't understand history. They live in the here and now. They can't see what's happening around the bend. They can't see that the bottom line is that a 4-point multiple expansion in a year is beyond weird. It's a 2 standard deviation event. And I will never invest in a 2 SD event unless the event involves a woefully undervalued security, asset class, or currency. Okay? Mm-hmm. So I'm actually amazed. And maybe I shouldn't be, because that is human nature. Fear and greed and fear. We had greed, didn't we? Have big greed in the summer and fall of 2007. We had big greed back in 1999. And that's just the nature, not just of the markets, but it's human nature. And we have this situation, and this is what's principally caused from a fund flow perspective, the market to continue to go up each and every day to these nosebleed valuations, is the bubble in passive index equity investing. Back in the mid to late 70s when John Bogle at Vanguard first unveiled this to the world, low-cost index investing, he famously said that we would never see this market get bigger than 20% of the overall market capitalization. We're approaching 60%. Index investing, passive, not active, passive investing in the equity market now surpasses active investing. And I'm not saying one is right or one is wrong. Active investing does mean you have to do homework. You have to do analysis. You have to look at balance sheets and income statements. You have to look at valuations. Passive investing is basically paint by numbers, okay? It is basically investing without doing any homework whatsoever. And of course, the inflows come in, and these funds have to be allocated into the overall market. So it's a self-reinforcing development. Mm-hmm. But the question we should be asking, especially these valuations, is what happens, and it's not if, it's when. What happens when the movie rewinds? And it always rewinds. What happens then? Especially when you consider that the economy and the stock market are more inextricably linked today than ever before in the past. They are hitched together. So I think that when you're asking me, well, waiting for Godot, and Godot never shows up, right? However, recessions do show up. And I am very concerned that this is not, I'm not talking about the fact that these are great companies, especially in technology. The stock market in aggregate is the most overvalued, top 10% overvalued of all time, based on price to book, price to earnings, price to sales, the Shiller PE, take your pick. And once the equity market does go down, and it will, from what level, who knows? What's the timing? I mean, come on. But the impact that negative wealth effect on spending has on the economy is going to catch a lot of people by surprise. And I want to make this point. You said you love the bondies. Well, yes. As I look at you, I just think bonds have more fun. But what I will say is that that's what I'm waiting for, because you go back to every market peak, stock market peak, stock market bubble peak. A stock market bubble peak involves a huge bear market. You've had bear markets before that didn't come off a bubble peak. 20% down is one thing. 40% plus down is another thing. When you come off a bubble peak, and we're in a price bubble, the valuations are in bubble territory. The 10-year Treasury note yield goes down, on average, 300 basis points to the fundamental lows. So people say to me, boy, you're so stubborn. You haven't abandoned your Treasury call. And look, we went down to 360 and now we're over 4%. They don't say, well, we got over 5% on the way to 360. Now we're at 4%. Okay, fine. But I am hitched to my equity market view. And I believe that this will not end very well. What the cause is, hard to say. Geopolitical, fiscal accident, the Fed dragging its heels, or maybe just a realization at some point that, boy, am I paying a stupid multiple on the stock market? Why am I paying 45 basis points equity risk premium? I'm paying to take on equity risk. I'm not getting paid to take on equity risk. So it could be anything. Bob Farrell, who is my mentor at Merrill Lynch, famously said, the market makes the news does not make the markets. And the markets do something, and then all the seers on Wall Street develop a narrative to fit to they develop a story to fit to the market pricing action. But I'd say that when you ask me what the principal risks are, I mentioned some already, but I think that the prospect of the bursting of this equity bubble and the impact it's going to have on an economy and on a household sector that has never been so exposed to risk is going to be problematic for the macro backdrop. And I want to have bonds as that ballast in the portfolio, not just basically that you'll get a huge total return as the price of these bonds accelerate. but I also want that diversification away from the prospect that the PE multiple at some point pulls that Bob Farrer rule number one mean reversion trade.
Yeah. I have to say, it's so fascinating just listening to you and getting that understanding of that symbiotic relationship between the markets and the economy. You mentioned bonds as a ballast. Okay, that's one area. Gold is popular on this channel too, and I think you might be into gold as well. But can we just step back and think about, okay, how are you preparing? What can you share with us about where you might want to be allocated? And do you have some exposure to equities? I take it you probably aren't completely out. Okay.
Well, no, I don't believe. I don't believe in concentration risk, and I don't believe. Look, there's two things I've learned after my 40 years in this business. Two things: that there is no such thing as a sure thing, and you don't put all your eggs in one basket. So I don't believe in 0 or 100. I believe in all the shades of gray in between, and how the probability curve is shifting over time. My equity allocation right now is about 20% in total. It's not 0. It's certainly not where people my age are already 60% in equities. The total household sector is 70%. I'm at 20. I'm basically, Julie, where I was back in the summer of 2007. Okay? And where I'm situated, and look, in a bear market, in a bear market in equities, everything goes down except one stock, which is Walmart. Walmart never seems to go down. That is your bellwether recession-proof stock. But I've been bullish on utilities. I've been really bullish on utilities and healthcare and consumer staples and telecom and defense aerospace, gold miners. Those 6 areas are actually up 30% in the past year. They've actually come close to matching the S&P 500, but they have visibility and they're very low beta and they have low cyclicality. So I would say that what's my overall theme? My overall theme is not cyclical. And the cyclical stocks have done well, but I do not have a cyclical bias because I'm not bullish on the economy. I have what's called the defensive growth bias in areas that also have dividend growth and dividend yield characteristics. So I still get a payout even if the overall market goes down. So those are the areas of the S&P 500 that I've been concentrated in. On top of that, yes, gold bullion, 100%. And the tailwinds behind that, I think the tailwinds will be instability and will be lower rates and a weaker US dollar. And that's all you need to know. Bob's your uncle, and you have to maintain your long position in gold. And gold is inherently difficult, if not impossible to value. It doesn't generate a cash flow stream. But it's really when the tailwinds start to turn to headwinds that I'll start to pull my plug on that call. We're not there yet. So those are the primary areas. There are areas of the market that I like as defensive growth characteristics with low correlations to the business cycle. And that's my 20% exposure to the stock market right there.
And on the bond side of things, I remember last time you had kind of briefly mentioned like the bond math, the focus a bit more on like convexity. It's not just like, okay, I'm going to buy the bond and hold it for 30 years. Can you just give us a little bit more color on how you approach investing in bonds? Well,
look, there's two things. Firstly is that, you can buy the bonds right now and at least get a yield, which you couldn't 3-4 years ago. So you'll say you'll pick up your 4%. But the longer the duration of the bond is, the greater the price appreciation is going to be on those bonds. And don't forget that, if bond yields go from 4% down to 3% or 4% down to 2%, they become a lot more valuable, right? Because, where are you going to, the U.S. government won't be issuing those treasuries at 4% yield anymore. So you're owning something very valuable. You're owning something that's generating a 4% cash flow. And so the longer the duration is, the more price sensitivity there is. So we go down to those levels, and never mind the 10-year note, the long bond will offer even a greater total return potential. So I am telling, I don't tell people what to do. I have clients, but I don't run money. Mm-hmm. I write a newsletter, and I just tell people what I'm doing. You can follow me or not, read me for the entertainment value or the information content. There's a combination, but I just tell people what I am doing. I don't force my view on anybody. And by the way, I never have. But the way you want to approach bonds in the portfolio, it's nice to know you have a yield cushion. It's nice to know that at least I'm going to get paid. The thing about treasuries, unlike anything else in life, you don't get this in gold, by the way. You don't get this in the most defensive parts of the stock market. You don't get it in the stock market. You don't get it in corporate credit. You know in the treasury market, whether you're taking out a 5-year, 10-year, 30-year bond, you know what you're getting in maturity. You know exactly what you're getting. Okay, so there is no capital risk. Oh, yes, there's inflation risk. There's rate risk. But there is no credit risk in treasuries. People will laugh at me when I say that. With 130% debt to GDP ratio, the U.S. government can't default. It can't default because there'll be a revolt amongst pensioners because most of the pension funds and life insurance companies have a whack of treasuries on their balance sheet. So how are you going to basically ever default? You can't default without creating a revolution. So there's no default in U.S. treasuries. So you know what you're getting paid at the end of the term. There's value in that. That's 100% certainty. No capital risk. But having the yield is nice, but that's not the principal reason why I'm advocating treasuries, especially you have this recent backup. It's for the total return. Total return. And it's no different than when I talk about the stock market total return. It's like, why do I like dividend growth, dividend yield? It's because historically 40% of the total return is coming from the reinvested dividend. So I look at things from a total return expectation standpoint. Once again, I said earlier, my assumptions drive my conclusions. I think we are going into a prolonged declining interest rate environment. The yield curve will normalize. Bond yields will come down. Bond yields will come down the most at the front end, but there's no duration there. So there's no price sensitivity. The long end provides that for you. So I'm advocating long-term bonds because every basis point decline is going to give you greater price appreciation. It won't be difficult in my forecast to get a 15 to 20% total return at the longer end of the curve over the course of over the next year. I know for people accustomed to multiple years of 30% plus increases in the total return in the S&P 500, 20% in bonds is like, who cares? But part of that 20% return in bonds, you have to risk adjust. You have to do your own Sharpe ratio on that because there's capital risk. There's two-way risk in equities that treasuries don't have that same two-way risk. Mm-hmm. So that's where I come at it, looking at a total return standpoint. And in the coming year, probably like 85% of your total return is going to come from the capital appreciation on your bonds, not from the yield. The yield is nice. It's only, it's a 2-bit player in this forecast.
Yeah. Well, I appreciate you sharing more color there. And I have to say, Dave, I love having you on. I love listening to you. I love learning from you. I hope we can get you on again. Maybe we'll get you on after the election, maybe heading into the new year. But it's just amazing. Like, I know the audience loves listening to you and learning from you. I want to give you the final 60 seconds or so here to let folks know where they can find you. I know you have a newsletter. Let them know more about Rosenberg Research. I imagine many folks would be interested in any parting thoughts that you might have.
Well, my parting thoughts would be, since we're heading into, we're in baseball playoff season. I'm a diehard Yankees fan.
Okay. There you go.
I'd say this is a time of the cycle to be bunting for singles, not swinging for the fences. That's what I would suggest to approach your portfolio and your asset mix. Play it safe. And in terms of where you can find me, you can just go Google Rosenberg Research, or you can go to information@rosenbergresearch.com. You can log in, get a free trial. You want to speak to one of my client service people. They don't like to be called salespeople. So, people in sales like to be called client service. And we do client service really well. I got to say, that's one thing that we don't have to face curveballs from the market to do great client service. You want to sign up for a free trial. I produce more than just one newsletter, by the way, but my breakfast with Dave is still the equivalent of the Big Mac for our firm. But come and kick our tires and taste our wares, and just come on the website, Rosenberg Research, information at rosenbergresearch.com. We'll take you right there, and we'll look after you.
I love it. Well, Dave Rosenberg, founder and president of Rosenberg Research, thank you for being so generous with your time, your ideas, all of your knowledge, your wisdom. You are always welcome on this channel anytime. Thanks again, and be well.
You as well. Thank you.